Hi, my name is Laurie Goodman, and I'm an Institute Fellow at the Housing Finance Policy Center at the Urban Institute. I'm going to talk to you today about assessing the potential for administrative GSE recapitalization and release. As most of you know, Fannie Mae and Freddie Mac, which are collectively known as the government-sponsored enterprises, have been in conservatorship since 2008. At the time of the establishment of conservatorship, there was no path for exit. The expectation was that the GSEs would be wound down and replaced legislatively with a new housing finance system. However, legislative attempts failed. There was a movement during the first Trump administration to give the GSEs a pathway to exit conservatorship, one that many during the second Trump administration have expressed an interest in pursuing. However, the pathways to exit conservatorship have only mapped the steps necessary to exit. They've never addressed what the new system will look like, nor who will it serve. It is important to realize that the GSEs play an absolutely critical role in the housing finance system. As you can see from the gray bars on this chart, GSE securitization is always been about at least 40% since 2007 of total origination in the mortgage market. So, and this is in the single family mortgage market, that is 1 to 4 family. GSEs constitute about half of the multifamily market. So it's really critical that we answer the questions of what the new housing finance system will look like before the GSEs exit conservatorship. Without a well-defined vision, exit from conservatorship could cause havoc in the financial markets and in the housing market. And we don't believe there's any vision on there's any consensus on what this vision should be. Today, we're going to look at where the GSEs stand now and how they got there. We'll look at the original preferred stock purchase agreement and its amendments, as well as the evolution of the GSEs during the 16 years they've been in conservatorship. Finally, we'll look at the questions that have to be addressed before the entities can be released. In September of 2008, the country was in the midst of a financial crisis. Fannie Mae and Freddie Mac were racking up large losses stemming from both the loans they had insured, that is their guaranteed book of business, and their then outsized investment portfolio. Their investment portfolio contained both agency and non-agency securities, including a large amount of subprime securities. The first signs of distress were felt in 2006 in the investment portfolio, when some of the subprime securities they owned deteriorated sharply in value. By late 2007, it was clear that delinquencies on the guaranteed book of business were also problematic. The guaranteed book of business contained a lot of non-traditional loans, that is, those with inadequate documentation, lower initial payments due to interest-only periods, and those with 40-year maturities. But it's not only the non-traditional products that were problematic. The delinquencies on the GSE's traditional book of business were also far higher than would have been predicted from prior experience. So the Treasury actually documented the vulnerabilities of the GSEs prior to the financial crisis in a 2011 report. So let's just look at these vulnerabilities. First, the GSEs had a profit maximizing structure which undermined their mission. That is, because they were privately owned through shareholders, they were encouraged to take more risks because essentially the shareholders got the upside while the downside was retained by the investors. So the structure of the entities themselves encouraged risk taking. There was an implicit government backing, which conferred unfair advantages both in terms of tax treatment, but particularly in terms of funding. So the favorable funding encouraged their outsized investment portfolio. Capital standards were inadequate, so they were retaining the capital they were required to, but it was a very, very low number. And their regulator was structurally weak and ineffective, and therefore did not fail to rein in any of this behavior. So in September of 2008, racking up large losses with questions in the market as to whether the GSEs could survive, they were taken into conservatorship. Essentially, the way it worked is in September of 2008, Treasury entered a preferred stock purchase agreement with each GSE, such that it provided each GSE with $100 billion line of credit to ensure they maintain positive quarterly returns. In exchange, the GSEs provide $1 million each in senior preferred shares valued at $1,000 a share and paying 10% in dividends annually. The GSEs issued warrants to the Treasury to purchase up to 79.9% of GSE common stock at a nominal cost, and they agreed to reduce their investment portfolios by 10% annually until the portfolio size was reduced to $250 billion. So this was the deal with each of the entities. This was amended pretty quickly. In May of 2009, there were questions as to whether that $100 billion line of credit was sufficient, and it was increased to $200 billion for each GSE. By December of 2009, with the losses continuing, there were questions as to whether even that $200 billion line of credit was sufficient, and it was replaced with a formulaic cap, which would increase the cap by any GSE losses from 2010 to 2012 and decrease by any gains subject to the $200 billion floor. So essentially, it had the impact of exempting any losses from during the 2010 to 2012 period from the cap. In August of 2012, the 10% annual dividend was changed to a full sweep of GSE earnings, and the portfolio wind down rate was increased from 10% to 15% annually until reaching $250 billion. This was very, very controversial. The purpose of this amendment this was very, very controversial because the amendment occurred just as the GSEs were becoming profitable. Fannie took its last draw from the Treasury in Q4 of 2011, and Freddie took its last draw from the Treasury in Q1 of 2012. Both GSEs were positive, that is, they made profits in Q2 of 2012. So there were a bunch of shareholder lawsuits over this amendment. The purpose of this amendment, according to Treasury, was twofold: essentially to keep the GSEs from retaining earnings so that they would never again become what they once were, and then also provide security to the market such that they would have assurance that these entities would never go through their credit line. Starting in 2013, Congress began to focus on legislative solutions to end GSE conservatorship. Remember, there was never any provisions to bring the GSEs out of conservatorship administratively. The intent was that they would be wound down and they would be replaced by a new system. So Congress in 2013 began in earnest to think about what the new system should look like. There were two basic approaches that were proposed. The first was the no government guarantee approach, and that was actually the best bill on that was the Protecting American Taxpayers Act of 2013, which was introduced by Jeb Hensarling, a Republican in Texas, and passed out of the House Financial Services Committee along partisan lines. It was never voted on by this full House. Essentially, this bill would wind down the GSEs within 4 years, create a national mortgage market utility to encourage standardization, and continue FHFA's mission of centralizing MBS securitization. So you'd essentially have a fairly homogeneous product through this utility. There would be no government guarantee, no affordable housing provisions, and it would limit FHA to just first-time home buyers and LMI borrowers. So that was the no government guarantee approach. There was also catastrophic government guarantee approach. The best representation of this was the Housing Finance Reform and Taxpayer Act, which was introduced by Tim Johnson and Mike Crapo. Tim Johnson was a Democrat from South Dakota, and Mike Crapo was a Republican from Indiana. And it was based on a 2013 bill with the same name, which was introduced by Mark Warner, a Democrat from Virginia, and Bob Corker, a Republican from Texas. This bill passed out of the House Senate Banking Committee in 2014 by a narrow majority, but it was never voted on by the full Senate. Essentially, this bill would wind down the GSEs within 5 years, replace the GSEs with a private, well-capitalized government guarantee entity that would securitize single-family and multifamily loans with private and would have private capital in the first loss position. That is, the private capital would absorb the first 10% of the losses. It would create a new government agency to insure investors against catastrophic risk and regulate the secondary mortgage market. Insurance would be explicitly priced and would cover the securities, not the entity. There would be a 10 basis point fee for affordable housing provisions. There were other bills along this line that were also proposed, including one by Delaney, Carney, and Himes, and another by Maxine Waters. But none of these bills ever got anywhere. That is, despite best efforts, these legislative attempts all failed. Meanwhile, the GSEs were not standing still. Since 2008, the GSEs have continued to evolve, beginning with FHFA Director Ed DeMarco, who was there from 2009 to 2014, Director Mel Watt, who was there from 2014 to 2019. Both of these gentlemen were strongly of the opinion that while the end to GSE conservatorships have to be done legislatively, the housing finance systems needs to move forward administratively within the confines of conservatorship, as it was unclear when the legislation would be implemented. So the first plan was publicly stated in 2012 under DeMarco's leadership in an FHFA paper aptly titled A Strategic Plan to End Conservatorships, the next chapter in a story that needs an ending, and was tweaked modestly under Mel Watt's leadership. So during these years, FHFA worked with Fannie and Freddie to significantly improve their operations. So they've basically focused on maintaining foreclosure prevention activities and credit availability for new and refinanced mortgages. They focused on taxpayer risk by increasing the role of private capital through credit risk transfer. This was a very, very significant development because it essentially allowed the GSEs to lay off a substantial amount of their risk to the private markets. They began to build a new GSE single-family infrastructure, including a common securitization platform, a single uniform MBS, which is called UMBS, and a heavy investment in systems, particularly their underwriting systems. And also they began to establish capital standards for the GSEs. These capital standards were first drafted under Mel Watt. They were finalized at a higher level under Mark Calabria and revised with selective decreases under Sandra Thompson in 2022. So there were huge changes in the GSEs since 2008, and the chances are if the GSEs had looked like they do today, they never would have experienced the stress that they did going through the financial crisis. Meanwhile, the history of the GSEs in conservatorship continues. There was a series of letter agreements between the GSEs, FHFA, and Treasury. In December of 2017, the GSEs had retained no capital prior to 2017. In December of 2017, the GSEs were allowed to retain capital for the first time of $3 billion each. and excess earnings over and above this would be paid to the Treasury in dividends. In September of 2019, the capital reserve limits were increased to $25 billion for Fannie Mae and $20 billion for Freddie Mac. The accumulated dividends were added to the liquidation preference, that is, the senior preferred stock that the Treasury received initially. Once the limit is reached, the earnings were paid to the Treasury as cash dividends. So remember, the sweep allowed for the earnings to be paid to the Treasury as cash dividends. And what this letter agreement said is, wait a second, no, they can retain capital, and the amount they retain will be added to the liquidation preference. In January of 2021, in the waning days of the Trump administration, the capital reserve limits were increased to $283 billion combined, in line with the 2020 capital agreements. The accumulated capital was added to the liquidation preference. Once the limit is reached again, the earnings will be paid to the Treasury as cash dividends. I should mention one other point that happened as well to the GSEs. The original FHFA intended that the director have a 5-year term and not serve at the discretion of the president. That is, it would be a 5-year term, and when that term expired, whoever was president at the time would be able to appoint the successor. So in 2019, the Fifth Appellate Court, in an en banc decision, said the director can be removed by the president at the president's will. So in 2021, Mark Calabria, who was then president, was replaced as FHFA director by Sandra Thompson. But and you'll notice that the timing of that third letter agreement was January of 2021, in the waning days of the Trump 1 administration. The January 2021 letter agreements also provided a very important roadmap for exit for the GSEs. Essentially, they allow the GSEs to be released from conservatorship by FHFA without explicit consent from Treasury when several conditions are met. First, litigation relating to the conservatorships is resolved. Second, when the GSEs build capital equal to 3% of assets, so long as the Treasury has exercised its full warrants of the GSE common stock and the MBS market is not disruptive. And under this exit from conservatorship, the lines of credit from Treasury would continue, but would be subject to a periodic fee once the GSEs retain capital at or above requirements. There were some constraints on GSE business practices. The portfolio caps were reduced further from $250 billion to $225 billion. Volume-based discount offerings on loans from lending institutions were prohibited, and purchases of higher risk and non-mission related loans were limited. Again, this was done in January of 2021, in the waning days of the Trump 1 administration. The Biden administration came in January of 2021. Pretty quickly, they suspended the purchases of high risk, and they suspended the limitation on higher risk and non-mission related loans. And in January of 2025, in the waning days of the Biden administration, they imposed a number of speed bumps to make sure that an exit from conservatorship would not be done irrationally. They made permanent the elimination of the business activity restrictions. They restored Treasury's right to consent to any action by FHFA to release the GSEs from conservatorship or put them into receivership. They reiterated that the senior preferred stock is senior to the junior preferred and common equity stock. And they committed FHFA to conduct a market impact analysis such that FHFA issues a request for information detailing specific options for the termination of conservatorship and solicits input on the potential impacts. Briefs the Financial Stability Oversight counsel on the public input and provides Treasury with a recommendation, after which Treasury consults with the president. So essentially, this was meant to slow down the process and make sure it was done more rationally. Obviously, this is not set in stone. It too can be amended. So to summarize what we've seen so far, a history of the GSEs and conservatorship. First, the PSPAs were created in 2009 to stabilize the GSEs. And again, that 79.9% limitation of warrants was done to avoid consolidating the obligations of the GSEs on the federal budget. There was no provisions to exit conservatorship. In the first few years of the PSPAs, there were a number of amendments. Treasury increased the support to the GSEs to assure the MBS market that the MBS securities didn't contain credit risk. The GSEs were later allowed to build capital. There were various legislative reform attempts, all of which were unsuccessful due to differing views on the appropriate amount of government involvement in the mortgage market. Meanwhile, the GSEs continued to evolve. They're very different entities than they were in 2008. The role of private capital has been increased through credit risk transfer. FHFA and the GSEs have developed the common securitization platform and the uniform MBS, and the GSEs have invested heavily in their system. Post-2020, the first Trump administration created the possibility for the GSEs to exit conservatorship through administrative channels, but the contours of this new system were not addressed. So where do we stand now? So you can see now, neither Fannie nor Freddie have sufficient capital to exit conservatorship. Would they have sufficient capital in 2 years? The answer, would they be able to achieve that 3% threshold in 2 years? No, they would be a little bit short based on current run rate of earnings. Fannie would be about 18 billion short. Freddie would be about 41 billion short based on our calculations. How much do the GSEs actually owe? So cumulative draws under the preferred stock purchase agreements were 192 billion. Current net worth is 147 billion. And remember, the current net worth, that is the capital that they are accumulating, is added to the Treasury liquidation preference. So they owe the Treasury 334 billion. Now, what some have argued is, well, they paid dividends back to Treasury of 301 billion. They borrowed 192 billion to start with. Therefore, they've sort of repaid the Treasury for the loans, and therefore that the liquidation preference should be forgiven. However, there was never any mechanism to forgive that liquidation preference. Meanwhile, Treasury's commitments under the PSPAs now total 254 billion. And again, the January 2021 letter agreements allow for the fact that the Treasury commitments under the PSPAs could continue if the GSEs were released from conservatorship and with the possibility of them paying a fee. So that brings us to where we are now. The biggest issue is we've never really, these entities, Fannie and Freddie, are huge in terms of the mortgage market. About 40% of the single-family mortgage market, about 50% of outstandings in the multifamily mortgage market. So they're critical, and we have to answer the question: what exactly are the new entities going to do? What problem are we solving for? Who would the new system be intended to serve? How would it be regulated and priced to assure it accomplishes its purpose? Would the GSEs have a broader or narrower mix of products? How would new products be approved? That is, how do you make sure that you don't end up in the old system where you privatize the gains and socialize the losses? Would the new portfolio restrictions stay in place? That is, would their investment portfolio be limited? Uh, how would the new GSE system interact with the rest of the mortgage ecosystem? That is, how would it interact with FHA? If you cut off mission-related loans, a lot of that business would be driven to FHA. So you're not really contracting the GSE you're not really contracting the government footprint. What about how would it interact with other private capital? So how is the new system going to be structured, and who would it be intended to serve? The second set of questions about the new system is the competitive landscape and the level of government support. In 2019, Treasury said, gee, we'd like to see a lot of new competitors in this market. However, if the PSPA lines of credit were to stay intact, would that be consistent with additional competitors? It would be very, very hard. So if they're going to be released with the PSPA lines of credit intact, how would the lines be paid for? And I think MBS investors would think it's very, very important that the PSPA lines of credit stay intact. If they're going to pay for these lines of credit, how would this fee apply to existing securities, and how would they be treated? Would the implicit government guarantee stay as is? Would the government make a statement that no further support is forthcoming beyond the PSPA lines of credit? And if so, would the market believe it? There are also questions about the MBS market and mortgage rates. So what would happen to mortgage rates, and what rate of return on capital would investors be entitled to? If you look at this slide, G fees now are about 64 to 65 basis points. If the GSEs were allowed to earn a utility-like rate of return, that would be about of 10% after tax. That would be about 76 basis points. If they were able to return a market rate of return of around 13%, that would be about 91 basis points. So there'd basically be a 10 to 25 basis point impact on G fees due to earning a rate of return on capital, depending on whether that rate of return is a utility-like rate of return or a market type rate of return. Plus, the G fees would also increase by the amount of the payment for the line of credit if there was one. But 10 to 25 basis points isn't a huge increase in mortgage markets, although it would be sizable. The bigger issue is what happens to the supply and demand for these securities. Right now, three types of investors own about 75% of the outstanding securities in the mortgage market. U.S. depository institutions own 35% of the securities. Commercial banks alone are 28%. The Federal Reserve System owns about 25%, and foreign investors own about 14.5%. The real issue in my mind is what happens to the supply and demand for these securities, and how much would that cause mortgage rates to rise. And a lot of that depends on what happens to the regulatory treatment of these securities, which in turn depends on how the administrative recap and release happens. So right now, mortgage-backed securities investors take only interest rate risk. They don't take credit risk. They think the government is essentially guaranteed the securities. As a result of this, banks have three advantages when they purchase agency MBS. First, they get favorable capital treatment for the MBS. Second, they get favorable liquidity treatment. And thirdly, they get an exemption from concentration limits, which are pretty substantial and apply to all other types of instruments. So they have a lot of regulatory advantages because there is a perception that these securities are essentially government guaranteed. The Federal Reserve can buy agency MBS. Question is, under recap and release, would the Federal Reserve still be able to buy the securities? And the answer to that is yes, as long as the PSPA lines of credit stay in place. But again, that has to be determined. And foreign investors are very large buyers, owning about 14.5% of the market. They rely to a very large extent on the implicit government guarantee. Does their perception of that get changed? And then total return investors are very sensitive to the downgrading of the MBS risk rating and the risk of any spread widening affecting total returns. So if these securities were to be downgraded for any reason, that would cause havoc in the market. But even if you did something like you limited, or the capital treatment was made a little bit more unfavorable for banks, and banks sold securities, you would have to appeal to the next investor group, and spreads would widen a lot. So when you talk about how much spreads widen in the mortgage market, a lot of it depends on the supply, what happens to the supply and demand of these securities, in addition to the return on capital. And the third component is what happens to the liquidity. So essentially, the ability of borrowers to lock interest rates is due to the liquidity of the MBS market and the existence of the to be announced market. That is, you can set, that is, if I lock the rate on my mortgage, my originator can essentially sell that mortgage forward immediately. The market, because of the UMBS market, these securities are fungible. Fannie and Freddie have taken great pains to align their policies through time. So, the fact that originators are able to lock mortgage rates allows them to hedge their interest rate risk. In the absence of that, it would be a lot more expensive to lock rates prior to closing, and a lot of borrowers would get to the closing table not knowing exactly what their risk is. So just to give you some idea of how important the liquidity in this market is, the top chart here shows the average trading volume of Treasury coupon bonds, corporate bonds, and agency MBS. And the bottom table shows you trading volume as a share of outstanding securities. And what you see in the bottom table is Treasury coupon Treasury securities and agency MBS basically have the same trading volume as a share of outstanding securities, and corporate bonds have much, much less liquidity. That is, they're just an order of magnitude less liquid. If that liquidity were to disappear because Fannie and Freddie no longer align their policies post conservatorship, you could see a widening of spreads because of that. So when you say how much do mortgage spreads widen, it really depends on three factors. First, what rate of return on capital would investors be entitled to? Second, what would happen to the supply and demand for these securities, and how would that cause mortgage rates to widen? And thirdly, what would happen to the liquidity of the securities? And then there are a bunch of questions associated with this. How would the existing securities trade versus new securities? Would they be fungible? Would the new entities need to coordinate policies? And if not, what would happen to the UMBS? What would happen to the super pools, which are Freddie securities and Fannie pools, and Fannie securities and Freddie pools? And would the borrowers still be able to lock their mortgage rates? Then there's a fourth set of questions about the new system in terms of IPO logistics and timing, sort of how would you execute this? So first, could an administrative recap and release be accomplished before the end of the second Trump administration? You need to establish the framework for the new system. The logistics have to be in place and capital requirements have to be met, or the preferred stock agreements have to be revised yet again. Would the initial public offerings be done together or separately? Is this feasible given the IPO size? That is, the Treasury share, that is, Treasury's holdings probably total something like 300 to 400 billion dollars. The largest IPO ever done was was the Aramco IPO that was 25 billion initially, upsized to 29 billion. SoftBank and Alibaba were sort of in the 21 billion range. What would happen to the government's liquidation preference? How and when would the government sell its warrant? So there are just a lot of questions in terms of logistics. In addition, there are alternatives to release from conservatorship. We've never answered the question, what exactly is the goal of release from conservatorship? If the government wanted to raise additional funds, they could increase the temporary payroll tax cut continuation surcharge of 10 basis points. They could increase it to 20 basis points. They could extend the term. It currently expires in 2032. They could prioritize profitability over mission. They could raise guarantee fees and increase loan level pricing adjustments to make the GSEs more profitable. They could crowd in private capital by raising guarantee fees, reducing loan limits, and reimposing limits on GSE purchases of certain types of loans. Pulte recently ruled out the of reducing loan size limits. They could cut back on affordable housing initiatives, eliminate special purpose credit programs, which they intend to do, and reduce cross-subsidization by selectively raising loan level pricing adjustments. So again, there's a lot of, they can achieve a lot of the goals that they want to achieve without release from conservatorship and without disruption of the system. So, you sort of say, well, what is the likelihood that they are released from conservatorship during this administration? My personal view is that there are so many unanswered questions as to what the new system looks like, given the critical importance of the GSEs to the housing finance system. I think it's reasonably unlikely in the next 4 years. Thank you very much.
Stop the recording.